Good afternoon, ladies. This is the second presentation for CC12. We're going to start to look at commercial banks and investment banks. I just need to find the correct item that we're going to work through. So I'm just going to go and find that in the short term, and then hopefully we will be cooking on gas. So if we take a quick look at this one here, and go into here, and then we need to find the second presentation, which is basically that one there, I think. Oh no, it's not. That's the actual presentation itself. I do apologise. So that's just to demonstrate that it does exist, and you have got that electronically provided. But clearly, the presentation I'm looking for is the second one on commercial banks and investment banks. So if you just bear with me for a moment, normal service will be resumed as quickly as possible. Oh, that's probably because I put it there, didn't I? So let's go back into on that one and that one, and close down, and basically should be able to find the second version, which just is escaping me for the moment. I think it might be this one. Yeah, I believe that is the one that we need to be looking at. So let's have a crack at that one then. So apologies for the slight delay there. We're going to be looking at the role of central banks. So we're really talking about on page 11 in your booklet. So the heading is obviously 4.2.4.2, which is commercial banks and investment banks. So we're going to be taking a look at that in a little bit more detail. Okay, there are some really quite nice videos within this and video links which I will keep referring you to, which give a really nice summary of, number one, some of the things that the Bank of England have to do, but also a little bit about some of the systemic risk issues that were faced when we looked at the issues of the banking crisis. So that's what we're going to be looking at in this presentation. Okay. So some of the things that you need to bear in mind, and again, if you refer to page 11 in your booklet, talking about the difference between commercial banks and investment banks, essentially. So obviously, there's some fairly significant differences between the two, which again are quite nicely defined within your booklets. So we'll certainly look at differences between commercial and investment banks, what the main functions of a commercial bank are, how a commercial bank's balance sheet might be structured, and also some of the objectives that a commercial bank might be faced with. And that can be to do with the level of liquidity that it holds, the profitability that of the business that it's doing, and also the level of security that is being provided by that particular commercial bank. Okay, we'll also look at some potential conflicts between those three objectives, so liquidity, profitability, and security. And as with most businesses, it's a case of a trade-off between making sure that you hold enough liquid assets so that if somebody wants to take the deposit out of your bank, that you've got sufficient liquidity to be able to do that, but also the level of profit that you're going to try to make from the business that you're doing and the sort of people that you're lending to. Okay, so clearly we'll look at some of the conflicts that are faced. We'll also look at how banks create credit. And also one of the things that you'll need to be aware of is the difference between a commercial bank and an investment bank. And you don't need a very distinct knowledge of the functions of an investment bank, but you should certainly be aware of the fact that lots of big banks have both retail operations and also investment operations, and fundamentally some of the issues around the financial crisis was that the investment banks or investment arms of banks were taking massive risks to try to resolve some of the issues that they'd sort of created in a sense in the financial markets, and that then affected retail banks, and there's been some legislation that has been put in place by the central bank to stop that, as we'll see as we go. Okay, so some of the key terms to research then. Need to find out a little bit more about commercial banks. Within page or on page 11 within your CC12 booklet, there are some good starting points in terms of what commercial banks typically are and the types of commercial banks that some of you will definitely be familiar with, but also a little bit more about investment banks, and we talk a little bit about the problem of systemic risk, where effectively one of the big issues faced effectively, if you get systemic risk, essentially that can cause the whole of in this case the banking system potentially to fall over, and clearly that is something that nobody really felt was a good idea or a way to sort of move forward. So there are some good notes within page 11 on systemic risk that you can take a look at. Okay. One of the things I'd like you to take a look at, and this link actually takes you straight to, in this case, 7 different roles that the Bank of England might have. So we talked a little bit about commercial banks and investment banks, but the central bank, i.e. the Bank of England in this case, basically there are 7 roles. Now, I just want to click on this link just to demonstrate that actually when you go to that first PowerPoint, which I'm hopeful that you'll see in a moment, there are a range of different things which actually explain. So in this case, there's part 7. Obviously, what I'd like you to do is watch them in order. So you've got part 1 here, right the way through to part 7. But each one of them, nice, relatively short, cartoon animated examples which explain some of the issues that the Bank of England have to try to face and some of the things that they need to consider. So take a look at those. There are some notes that I'd like you to also take based on the information that's provided later on in your booklet, which is, if I just flick through to the Bank of England info, I believe that is, or there is space a little bit further on, around about sort of page 21, and it actually breaks it down quite nicely to show the different types of things, different roles that the Bank of England has to perform in order to discharge its responsibilities. You'll also see there's a range of case studies and questions that have been included in the booklet, which again are just quite nice examples of relatively recent examples of, in some cases, market rigging. We've got some information on mis-selling of products and services, and also PPI. But there's a whole bunch of stuff which actually explains quite nicely some of the issues that were being faced both by the Bank of England, but also when we had the banking crisis, as you'll see. Okay, so I'll just move back to the original PowerPoint. So basically, a range of different things that the Bank of England has to do. It has to issue money. It has to provide prices and value for your money. It has to control spending. It has to try and manage the financial system. It's also responsible for the money go round, and very much the central banks are responsible for keeping confidence in the system and the fact that the system isn't going to fall over and people and banks are going to go out of business, etc. And then finally, how the bank works. So there are 7 short videos, as I mentioned. I think they're each about a couple of minutes long, but those are give quite a nice summary of the different roles that the Bank of England has to perform. Okay. I'm jumping around a wee bit here, but I think it's important that we sort of cover some of the key things that are important in this particular sector. And one of the things that obviously is very important and still quite current and is still being talked about an awful lot in economic circles is this principle of bank bailouts and what happened when the crisis of credit hit during 2008-2009. Now, the video that's included here, the live link that you can see here, if I sort of roll over the YouTube link, it's about 11 minutes long, but that goes into quite a lot of detail about the whole issue around the bank bailouts. It's a really useful way of accessing the information, and it's done in a reasonably entertaining way. There's quite a lot of heavy detail in terms of some of the technical jargon that's used, but the principles are quite useful just to sort of understand how that whole process happened and what some of the issues were that the Bank of England had to face, but also the banking sector overall had to face. Things that the Bank of England do, regulation of the banking system. Clearly, there are lots of reasons for regulation. Number one, to try and avoid market failures that could be caused by a range of things. One, obviously, being asymmetric information. We've talked about that before, haven't we? But in this instance, obviously, that's one of the things that the Bank of England is attempting to do to try to avoid any sort of market failures and to regulate the whole process to make sure that the banking system is actually behaving in the way that it should. Other things that are the reasons for the regulation of the banking system to avoid market failures that might be caused by negative externalities, and again, some quite nice examples included on page 13, 14, and 15 in your booklet. Okay, and certainly to avoid any sort of systemic risk. Now, one of the issues is that clearly, if you get a banking system that has systemic risk built into it, for want of a better term, that is a very dangerous thing. In that, if the system essentially falls over and isn't successful or isn't able to cope with those sort of massive shocks, then clearly that's the reason why the Bank of England has put in place a whole range of different regulatory processes to try to avoid, if there is a similar run in the future on the banking system, that there are checks and balances in place to make sure that those things are not going to cause the whole system to fall over like it very nearly did back in 2008, 2009. There's been a number of changes of regulation since the financial crisis. There's been new structures to monitor and regulate. One is the Financial Policy Committee, and that's part of the Bank of England, and they cover a range of different areas. There is another area called the Prudential Regulation Authority, and these actually are covered in the 7 short videos that I mentioned to you previously. The third one is the Financial Conduct Authority, and those are all designed to try to protect individuals, consumers, and also the system, the banking system, from collapse or from basically those regulations have been put in place to make sure that the same sort of thing that happened 10, 12 years ago can't happen again, because the early warning systems, etc., and the checks and balances that they've put in place mean that shouldn't actually be an issue in the future. There is a stress testing process that the Bank of England uses, and that basically is explained in a short video, and that's based on the fact that we're trying to keep the financial system safe. So basically, what the Bank of England will do will stress test UK banks. They'll make sure that if this scenario happens, what would you do? Have you got the enough resources to be able to carry on and keep the financial system safe? And again, it's got a nice video which explains that process of stress testing, which has been produced by the Bank of England, which I'd like you to take a look at. The other major change was that based on this separation, it's now a separation, based on the fact that prior to the financial crisis, investment banks and the retail operations of banks were basically all part of one. The Bank of England decided that it was a good idea to ring-fence retail banking away from investment banking arms of organisations from 2019, so that effectively retail banking won't be adversely affected by the more risky investment banking that goes on, and obviously that hopefully will maintain the integrity of the retail banking system. And so if something of this nature happened again, you wouldn't have the same sort of problems that we faced during the 2008-2009 crisis. In some cases, the Bank of England will carry out some sort of resolution process. So they might look to either help bail out a bank if it's considered to be in the public interest, or they might bail it in. And what they mean by that is they might choose to buy the assets or manage the assets of a particular bank if they're in danger of falling over, for want of a better term. So that's another thing that they've also put in place to make sure that the financial sector is much more robust, and the sorts of things that happened back in 2008, 2009 essentially can't happen again. Certainly one of the main things, the main drivers of some of this changes in regulation have been to try to protect consumers, particularly as far as the Financial Conduct Authority is concerned. So their whole raison d'etre, the reason that they exist, is to make sure that consumers are protected. And some of the examples that I've mentioned to you previously, like PPI and market rigging and various other examples, are included as case studies in the next few pages of your booklet. So that I think will be really useful to be able to get your head around some of these principles, and also have some good examples that you can refer to and quote in any answers or responses that you might need to, as far as the whole financial crisis is concerned. Examples of the intervention to protect consumers. One of the areas was payday loans, which some of you might be familiar with, where businesses were charging people who were struggling to sort of keep to have enough money to sort of manage their finances day to day, but were being charged massively extortionate loans, which were certainly not considered to be in the public interest. The PPI mis-selling saga that I'm sure your parents and anybody that of a certain age will tell you all about, and the number of times that we receive emails and texts and phone calls from various people saying, "Have you been mis-sold PPI?" All those sorts of things have been investigated, and the banks have actually ended up paying one hell of a lot of money back to people because of the mis-selling that took place during that payment protection insurance scam that went on for some time. And the other area is obviously credit cards, and the fact that some credit card organisations will charge significantly higher interest rates than normal, and that in some cases is considered to be not in the public interest. So all those sorts of things have been put in place since the financial crisis to try to help make sure that we don't get the same sort of thing happening again in the future. And another area is rent to own and then buying to let, which so all areas that are sort of designed to try to protect consumers, and the Financial Conduct Authority is the organisation that is responsible for going and investigating those things, and in some cases, drawing up legislation to stop those sorts of things happening in the future. There's quite a nice article that I'd like you to take a look at, which was to do with the Financial Conduct Authority, and one of the issues around this whole area is that the view was that the regulators were a little bit too close to those people that were responsible for some of the issues around the financial crisis that happened. So there is an article which I'm just trying to find a reference for within your booklet. So on page 17, you've got your PPI question. You then got a mis-selling of savings products, which was to do with First Direct. We've also got some market rigging there, which was to do with the way in which 6 global banks were attempting to rig foreign exchange markets so that it suited their own particular principles. And then we've also got some externalities, which was to do with the Royal Bank of Scotland, which ended up getting taken over pretty much by us as taxpayers, essentially. Okay, so again, some nice examples that you can take a look at, and hopefully that will make a reasonable amount of sense. And also, as we start to look at it in a bit more detail, we'll move on to look at the way in which monetary policy, in particular, is implemented. Okay. Some of the issues that are also worth bearing in mind then, and some of the advantages of regulating the financial sector include the 3 bullet points that are included there. So in some instances where this regulation is designed to try to prevent financial institutions from taking excessive risks. If you look back at some of the issues around the previous financial crisis, a lot of it was down to banks taking excessive risk and charging high levels of interest because of the risks that they were taking. So that clearly is one of the things that we've tried, that the Bank of England and the government has tried to put in place to make sure that the regulation of the financial sector is much more rigorous than it ever was previously. Another thing that banks are now being asked or being told to do by the central banks is to keep enough capital and liquid assets, such as government bonds, as a safety buffer. So if things do go wrong, then clearly they have the ability and the resources and reserves to be able to do something about that, to resolve the issue. So one of the issues around inadequate regulation is that those things were certainly contributory factors to the banking crisis and recession that we saw in 2008, 2009. And clearly, if we get to a situation where a bank is getting into some sort of financial difficulty, if we start to get a loss of confidence, and also something known as contagion, where effectively it's a bit like, if you like, the pandemic. If it's a contagious thing, what tends to happen is that if people lose confidence in one financial institution, that can very quickly spread into the whole of the system. And clearly, one of the issues around that is making sure that banks aren't seen to be properly getting their risk taking, and also one of the other things to bear in mind is that if we get this situation where banks start to get in financial difficulty, if we take a look at what happened in 2008, 2009, or the immediate aftermath, even though the Bank of England and the government was trying very hard to encourage more banks to lend more money, they weren't willing to do that because their risk profile, because of what happened previously in the marketplace, they had chosen to be much more careful about who they might lend money to in the future. So effectively, although what the government and the Bank of England was trying to do was to try and encourage more spending and more lending of money in order to encourage more aggregate demand, and hopefully that resolves some of the issues around the recession of that 2008-2009 period. The problem with that is that in some cases banks might not be quite so keen to lend money, and clearly, dependent on levels of business or consumer confidence, there's a danger that people might still choose not to borrow money, or they might choose to invest less, and that's then going to lead to lower levels of aggregate demand and lower increases in, or in some cases maybe even a fall in GDP, which might then develop into some sort of recessionary situation. So those are some of the advantages, some of the disadvantages or limitations of regulation. Well, clearly, regulators in this instance have imperfect information. If we've got asymmetric information, then in some cases, if you take financial markets as an example, very, very complicated to understand and very risky at times in order to understand what that process is all about. And you can also get this issue of regulatory capture, which essentially means that regulators may be influenced by the institutions they're supposed to regulate. If, as we were mentioning earlier, if regulators are a bit too friendly with senior managers within private sector financial institutions, then maybe it could well be that the experts that you're relying on to advise you might actually come from the private sector, and as a result of that, there are, I'm not quite saying it. I'm not saying it's mates jobs for the boys essentially, but there is a danger that regulatory capture might actually also happen too. Regulation obviously is an important principle, but the argument is that if it's too tough, then that might mean that businesses might choose to relocate, or banks might choose to relocate to other countries if the regulations of within the UK are too tough, and that then can have an impact on the level of jobs and incomes in the UK. That could then fundamentally then reduce tax revenues for the UK government, and obviously that then creates its own set of problems. If we take the other principle there, then if we're saying that banks might actually, if they're being told that they've got to keep high levels of capital or liquid assets, that might mean that they're going to reduce their lending, and that's then going to mean that could affect consumption, investment, aggregate demand, and economic growth. And clearly, all of those areas are considered to be very sensitive to changes in this case, the banking systems, lending policies as such. So both the UK and the US governments have been in favour of this sort of soft touch regulation, where effectively, rather than being very tough in terms of regulation, it's almost well, if you self-regulate, then hopefully that's going to allow more money to move into the market, and hopefully stimulate growth, economic growth, aggregate demand, and jobs, etc. And so overall increase in GDP. A couple of exam questions that you might like to consider. So this is a paper 2 sample question and case study. With reference to extract A, explain the role of forward markets in currencies. That's a 5-mark question. I'll just try and find the reference point for that one in your booklets, but there are a range of questions that you can take a look at, which hopefully might help you to understand that in a bit more detail. And then another example there of a 15-marker, discuss whether providing substantial government financial support to banks is the best policy during a financial crisis. So in some cases, they're, again, just a typical example of questions. I'm not asking you to do them necessarily at this stage, but certainly you could be thinking about how you might go about answering both that 5-marker and that 15-marker. Okay, so thank you for listening, and hopefully we can have a bit of a chat on when we have our teams get together, and hopefully that will allow us to make sure that we understand all of the stuff that we've just gone through together. And I'll speak to you soon.